We're going to pitch it as a way where not only can you buy the life insurance covers, but we're going to have those dollars grow. We're going to have those dollars be invested. We're going to have those dollars pay a dividend. But we think, our opinion is, your strategy that you just said makes a lot more sense. We want our insurance products to be insurance. We want our investment products to be investments. Because what we find is when we mix those together and we have them serve a dual purpose, neither of those purposes are optimized, and we think that it's not the best solution. There's a few different reasons why we say that.
Now, wait a minute. I want to stop you because, look, we don't sell life insurance. So I think if I was an insurance professional, I'd be like, well, these guys, they're going to just try to push you towards something that they deal with versus what we deal. But don't take our word for it. Daniel in the notes, and you can do your own research on this, Consumer Reports had an entire write-up on whole life insurance. Mm-hmm. Is it right for you? And you can go do your own Google due diligence on this. But from their findings, they found that this more conservative type of investment or thing that you're buying to provide coverage that we already shown is 20 times the cost of term is only typically providing a rate of return between 1.5% to 3.5% per year on average.
And that's on average after all the fees and all the expenses, because what you often get pitched on, there's this guarantee, there's this dividend rate, there's this rate of return that you're going to receive on this if you're talking specifically about whole life, on this whole life policy. However, one of the things that's really, really interesting is that guaranteed rate of return. You would think, as we've moved into this environment where interest rates have gone up and cash a couple of years ago was paying nothing, but now we're seeing cash paying rates as high as like 4.5%. You would think that the dividend rates on those whole life insurance policies would have been the same. They haven't. They've actually stayed flat or actually decreased slightly. So these dividends, this guaranteed return, doesn't necessarily move with interest rates. So if we do enter into a time period where we have really high inflation, like we've seen over this past couple of years, these policies, often the growth rate that's embedded in them, even if you were getting the full dividend rate, not factoring in the fees and expenses, wouldn't even keep up with higher levels of inflation.
But maybe we're looking at this wrong. Maybe the guaranteed type of product is not right. That's your whole life. What if we transition to maybe a variable life insurance policy? Because there's even products, because these insurance companies, they're no fools. They've actually structured products that actually allow you to have some component to participate in what's going on in the stock market. What's the issues with that?
Yeah, so a lot of times what they'll do is say, okay, great, you can invest these dollars. And then what we're going to do, though, is we're going to put some caps on them, or we're going to make you subscribe to a capture ratio.